Sponsored by Chartered Financial Strategies. You are now watching Tax Bytes.
All right, welcome to another episode of Tax Bytes, and this is a continuation in the series Tax Playing the Myths. And we talked about the first myth, which was how income tax planning specifically really is not necessarily a dollar for dollar return or reduction of tax. It'll be a percent of what you put forth in your plan related to an income tax benefit. And that's just the way tax rates work. You put $1 in, you save 20 cents, that kind of a thing. The second one was that it's not always about income tax. There are other taxes, estate tax, or there's asset protection strategies that are put in place, kind of wrapped in a tax plan of sorts, that really are what it's about, can be about. And this today's myth is going to be somewhat a dovetail or kind of an addendum to that one. This third myth is that the benefits of tax planning are measurable, meaning dollar savings somewhere. I'm going to spend this much to get a tax plan, and I'm going to get this dollar benefit that's going to be measurable. And I'm going to say a lot of times it's not, no more than your insurance policy. You know, you buy a homeowner's insurance policy year after year after year. You don't want the fire. That's when the benefits of that policy are measured. This is a lot how a tax plan that's kind of driven towards, especially towards liability or estate planning and so forth, where it can increase your cost. It can increase the complexity of your record keeping. Just take a sole proprietorship business that we say we're going to break up or turn into a corporation, maybe a couple of corporations. And in doing that, we create multiple, tax returns. And you might have to create payroll underneath that to disperse income out even to yourself. So you have quarterly payroll returns you have to file. You have special bookkeeping you're going to have to do related to that business a bit differently than a corporation to some extent. You may have to meet with yourself through a board meeting. And I call it that bipolar moment where you have to elect yourself president of a board or whatever and then approve certain things. But you have to do these things to legitimize the business entity you're operating under. And it complicates things, can increase costs by all means versus a sole proprietorship operating it differently where you don't pay yourself payroll. But you get the liability protection of, say, this corporate entity. Same thing with a trust. If you're going to roll assets into a trust at this point in time, you may have to do certain kind of trustee operations, record keeping, all those kinds of things, to justify what's in the trust, how it's administered, and those things. And that can complicate, plus potentially have a trust income tax return every year. So all those things can actually be valid under this kind of a plan, but they are going to require additional administration and cost to do so. And so a lot of benefits may not really translate into a reduction of tax or some other reduction in cost. It's just an increase in liability protection, which is largely immeasurable, or transfer of assets, as we talked before, or estate planning, those things. So the basic point is a lot of tax plans may not have a dollar benefit easily assigned to it. And you have to, again, look to those larger goals. And are those larger goals important to you? And is this cost and complexity, an equitable balance between the two? And that's really the learning. So I hope that's been beneficial. Hope you learned something. That's the tax by the day. So please like, subscribe, and comment, and have a good day.